Hello and welcome. You're watching us here on Trading Hour. I'm Manglam Malu. With me, Reema Tendulkar as well as Pavitra Pradhik. The first hour of trade today belongs to the Bears and how. In fact, why just the first hour today? The last hour yesterday and the previous couple of trading sessions as well. After a big rally that we saw over a few days on Friday, Monday, then we had a break on Tuesday. The market's given up almost 50% of those gains. The Nifty just below that 17,400 mark, below the 200-day moving average as well. Weakness across the globe is what's playing out on our market sentiment as well. We have weakness coming in from the Nifty, bank, the IT stocks, barring FMCG, all indices in the red. Hi, Pavitra.
Hi, Manglam. Good morning. So, like you said, we have seen this weakness across the board, reflecting everything that we saw in the global markets. In fact, I was looking at it for the week, and everything barring the PSU index, the CPSE index, is in the red for this week. So, the move will come up for a few of the larger ones. So, the CPSE index is up 1.5%, but everything else has seen a cut. So, the real estate index is down 3%, for example. PSU banks down 2.9%. The Nifty bank in itself is down 1.6%, and Nifty IT also, which during the beginning of the year was holding up. For this week, that is down 1.3% as well. So there's definitely weakness across the board. Today, it is led by the financials, like we've been pointing out. So a lot of the banks will come up for you. In addition to the banking names, you also have something like a Bajaj Finance, which, by the way, for this week is down over 4.5%. So do keep that on your radar. And we have been talking about the kind of pressure that we've seen because of Reliance Industries as well. And, because of its sheer weight in the index, that one is important to track. What's doing well, and if you want to look at a little bit of a spot of green, is the FMCG pack as well as the sugar names, which have been surging. This is the third straight day of gains for the entire sugar pack. So that's what's going on with the global markets. But, the big story is really what's happening with the global markets. So Reema's moved over to the big wall to bring us the setup. Reema?
Oh, thank you very much for that. Across the board, there is a sea of red that you can see. Hang Seng is down close to about 2.5%. The Korean markets have slipped 1%. The Chinese markets are lower by 1%. And this is tracking the weakness that we had in global markets or Wall Street overnight, where the key indices, the Dow to the Nasdaq, were down 1.5% to about 2%. So the question is, what led to this kind of a weakness? Well, two financial stocks collapsed in the United States yesterday. SVB Financial. This is the parent company of a Silicon Valley bank, which largely banks and funds tech startups. And SVB Financial plunged 60%, and the stock is now trading at the lowest level since September of 2016. The second one was Silvergate Capital. Now, this is a US crypto-focused bank, and this stock, Silvergate, saw a decline of 42% after it disclosed plans to wind down operations and voluntarily liquidate. The ripple effect of these two financial stocks crumbling was felt across the US banking stocks. So KBW Banking Index, this is a benchmark stock index of the banking sector. It has 24 US financials under its belt, and that saw a decline of 7%, its steepest drop since June of 2020, which was in the aftermath of COVID. What is the market worried about? The market is worried about potential losses in the huge bond portfolios held by other US banks. Remember, most US banks had invested the deposits that it got during the coronavirus pandemic into long-dated securities like treasuries. The value of those treasury, that holding, has fallen sharply in the last 1 year as interest rates have started rising very rapidly. And banks are sitting on potential losses on their bond portfolio. So we had SVB Financial crumbling in trade, but the market fears that other banks too are sitting on large losses too. And secondly, the high interest rates over the last 1 year have also hit the frothy corners of the market, the tech and the crypto, because both the two financial accidents which took place, one, SVB Financial catered to the tech startups because it used to bank the tech startups, and Silvergate was banking the cryptos. And here's a quote that we picked up from Uday Kotak, where he tweeted, "Overnight developments in the US banking, in the banking space, analysts, investors underestimate the importance of financial stability for the balance sheet of a bank, because when interest rates move up by 500 basis points from 0 to in a year, an accident is waiting to happen somewhere." And that's exactly what happened, an accident. Apart from that, there is also some amount of anxiety about the non-farm payroll data, which comes out at 7 p.m. India time. Remember, the January jobs data was a sizzling hot number. Not just hot, it was sizzling hot. The market was expecting a number of 200,000. We got a number of 500,000. And this jobs data has beaten estimates for 10 straight months in a row, the longest since 1997, which basically means the markets are underestimating the strength of the US labor market. And if the labor data, the jobs market is strong, it's harder to cool inflation. And that means the Fed needs to keep hiking, and that could tip the US economy into recession. And that's also what the US Treasury yield seemed to suggest. The 2-year yield has cooled now below the 5% mark, but earlier this week it was at 5%, while the 10-year yield is now at 4%. So the gap between the two is 100 basis points, the most extreme since 1981. So these are the two factors playing on the global markets, and right now it's kept the bulls away.
All right, Reema, thanks a lot for summing up everything that's going on in the global markets for us. But in fact, staying with the global markets, let's also invite our first guest on the show. We're joined by Rajat Bhattacharya, who's a senior investment strategist at Standard Chartered, to take some questions on this and how the global markets are likely to move from here as well. Rajat, thanks a lot for joining us. This is Pavitra. You know, I'll come to the Fed rate hikes, all of that in a bit. But first, just on this news that we got overnight on SVB, how do you read that? You know, anytime there's some news flow of this variety that comes out of the financials, it's just heightened nervousness, right, that we see in the markets. Do you think the pressure on the banking pack is likely to continue because of what we've seen here?
Morning, Pavitra. Thanks for inviting me. To be honest, these shouldn't be surprising us. What we've been saying in your platform and elsewhere is that when rates rise so sharply, this has been the second steepest Fed rate hike cycle in history. When it rises that much, accidents are waiting to happen. And that is why, since the start of the year, we've been positioned very, very cautiously, defensively. So, in the specific case here, I mean, we are looking close to towards that. These are small banks. And we know that the large banks, large US banks, are very well capitalized. The Fed's focus has always been on the large banks. So they are secure in that sense. But we need to watch the contagion effect, right? So the contagion effect within the small banking sector, if that spreads towards the medium-sized banks. The large banks, as I said, I mean, are very well capitalized.
Right. Rajat, a lot is happening in the US, the global market, so to say, because on the one hand, the Fed is now talking up its, or it's increasing the tone towards hawkishness once again. Secondly, we have some data which is due with regards to the labor markets, etc. And thirdly, with all these accidents taking place, so to say, I'm sure there could be some more as well, as Uday Kotak has pointed out. There are offsetting cues. What does the Fed do in a situation like that? And what are your own expectations? Is it going to be a 25 basis points hike, a 30 basis points hike, a 50 basis points hike? Where do they stop? Where do your terminal rate expectations go from here?
Yeah, that was well explained, I must say. What happens is now there's a tug of war, right? So we were, before what happened last night, I think the market was expecting a 50 basis point hike because of the strong data, including inflation and activity data in the US. And especially after what Powell said, that he was considering a step up again in the pace of rate hikes. But I think after what happened last night and in the markets, they're going to be cautious. So if I were to put my money on it, basically it's around 25 basis points is where they will stick to for now. But as you said, tonight's non-farm payrolls is critical. Next week's CPI data is critical. Those are the two data points that Powell clearly said he's looking forward to before they make a decision. So depending on how hot these two data are, and as the reporter earlier mentioned, the job market has been very tight for long. If that tightness continues, they might still go for a 50 basis point hike. But this market reaction that is already happening makes the case for a steady pace of 25 basis points, and then they will see, they will watch the data closely.
So Rajat, what you're saying is 48 hours prior, you were anticipating a 50 basis points rate hike, and now you've toned it down to 25 basis points?
Well, we don't change day to day, but our base case, I must say, it has been 25 basis points before. Okay. But based on the data and what Powell said, the market and along with us, I mean, we had raised our expectation. All of us had raised our expectation, but this throws a spanner to that, right? So I am looking very closely to the two data points that I mentioned, CPI data and the non-farm payrolls tonight, to decide. And the Fed, I'm sure, is also looking towards that.
CPI inflation print comes out on 14th of March, and then the FOMC meet is on 21st and 22nd of March. So basically, the decision comes out 22nd March US time, so Indian markets react only on the 23rd. And the Fed goes into a silent period, right? They won't be making any statements after Saturday. So they go into that quiet period. Rajat, so you're very cautious on the global markets as things currently stand. What about India?
Yeah, India, I mean, and the broader Asia sphere, it has been our, area of preference since the start of the year. As I said, we were defensively positioned getting into this year. We were skeptical about this big rally that was happening in US equity markets since October, November. And we were asking people in January to fade the rally in US and European markets and move some of it towards Asia. Within that, India, of course, is a bit expensive. So whereas China was very cheap in valuations, so we were asking people to focus towards Asia, but within that, look towards China. What we heard over the last 1 week in the China's Congress, actually, they reiterated their need to stimulate the economy, the domestic economy, through consumption. And that's beneficial for the consumption-driven sectors in China. So again, there's been a rally there, and then there's been a consolidation in Chinese equities. It's a good opportunity for people looking at Asia to really focus on some of those targeted sectors, consumer-focused sectors like consumer discretionary or communication services, which are going to benefit from these policy measures that China has announced. And those are the areas to focus. In India, we would actually prefer bonds over equities because of the reasons cited. I mean, the RBI has raised rates. We are closer to that peak in rates in India, and it's a great time to buy bonds. So if you're underweight there, you should be looking at bonds right now.
Okay, got that. Rajat, one quick question on what we're seeing play out with the dollar. A, do you think this move is likely to sustain? And B, if it does, then would you look at commodities in this context?
So the dollar benefits, the dollar smile, so to speak, benefits in terms of prices. So if this, this problem that is emanating from the U.S. markets in terms of the small banks, this could benefit the dollar. Dollar has, reversed its recent losses, and in the last few weeks it's been gaining. Along with the risk-off sentiment. So risk-off sentiment should prop up the dollar, I would say, for a while.
Well, your sectoral preference right now is bonds over equities. But if one was to be in equities, what places do you think would provide some sort of safety and maybe at least as much returns as bonds, if not more?
It's going to be challenging for equities to beat bonds this year. Where bond yields are, where the rates are, we are closer to the peak in bond yields and rates than we are closer to the bottom in equity prices. Equity, prices are not estimating a downturn, right? We're expecting a recession in the US and Europe, for instance, and the consensus earnings estimates there are not pricing that in, nowhere near. So to your question on where in equities, within equities, while we prefer bonds over equities, in equities we prefer Asia ex Japan, and within Asia ex Japan we prefer places like China, which is still underpriced globally.
Rajat, we'll leave it at that. Thank you very much for joining in. The view coming in from Standard Chart. Get into a break. On the other side, we'll continue our focus on the markets. Rohit Srivastava of IndiaCharts.com joins in next. Welcome back. Let's talk about the Indian markets. Rohit Srivastava, founder strategist of IndiaCharts.com, joins in to discuss the way forward. Rohit, early this week, we were thinking that markets are likely to break out. There was so much momentum on the way up. And that suddenly turned, right, from yesterday's price action and today the way markets have fallen. more than 150 points. So still very much back in that trading range. Your thoughts on the way forward?
So the action that we are seeing in the US does raise the potential risk that can the market really fall some more from here. If we break, say, 17,300, we would have to open up to the idea that we can slip towards 16,900. But I'm not putting a certainty on it. The thing is that the market sentimentally has been, pretty oversold, because when we generally look around, sentiment is the most bearish that we have seen in years. And beyond that, if we think about when this entire trading range, not just the short-term one, but the longer-term one really started, it takes us all the way back to October 2021, right? That's where the market started to gyrate in both directions. And we have seen after that even one new high and then this sell-off. So the period that we've completed is around 18 months, which is sort of equal to what we spent post Y2K from the peak of March of 2000 till October. And just inverting the months, starting from October, now we are in March of 2023, 18 months later. So we are sort of at the end of a time, sufficient time for a bear market to complete. We are also at the end of a period where sentiment has turned extremely negative. So sort of the setup is not one where I would be comfortable turning too bearish. It's possible there are some short-term gyrations. I think over the last month, twice at least, we have seen the index break to a lower low from 17,800 to 17,350 and then to 17,250. So if we do break 17,300, can we drop to 16,900? Sure. That's around a 200, 300 point downside risk that can open up. It hasn't opened up yet. But on the other hand, we might just be reacting to global cues, while this might be just a bottoming out phase, because you can see the relative strength of either the Indian banks, because the bank Nifty is actually not made new lows compared to the Nifty in the last month. We also see the similar relative strength in the mid and small cap space, where individual stocks are still holding up well. If you look at the strong sectors like defense, capital goods, many of these sectors are actually holding up pretty well compared to the Nifty. So it doesn't really look like this is a panic, sell everything and go home situation. We are reacting to global cues, but it still remains a bottoming out market from a slightly longer term perspective, keeping some short-term risks open if we do break certain levels, but otherwise it may just be basing out around here. Two of the big macro factors which I think have scared everybody, we can look at both in the US and India, has been the 10-year bond yield, right? So you have seen the US 10-year bond yield jump. In fact, the 2-year bond yield, not even the 10-year. The 2-year bond yield really jump up over the last couple of weeks. But last 2 days, you've seen it actually ease, especially after yesterday's negative news flow. And you've not really seen the long bond, which is the 30-year, fall along with the 2-year. So while you had 2-year yield jumping because the 2-year bonds are falling, the 30-year was not accompanying it. So that's an intermarket divergence typically seen at the fag end of a move. What I'm really trying to say here is that the jump in US interest rates in the 2-year yield, which has been creating a lot of the scare right now, is at the fag end. It may have, in fact, even peaked in the last 2 days. So you might actually see bond yields start to cool off. They'll probably not go beyond this 5%, 5.25% mark. And that will sort of ease pressure on the markets. We didn't see that yesterday because of other news related to a particular bank failure.
Your commentary
but
seems
otherwise,
to be...
I think...
Right. Your commentary seems to be working like a balm on the frayed nerves of the market right now. We're back above that 200-day moving average on the Nifty. We have recovered a fair bit from the lows. Of course, it's been a tough day, but still down 150 points on the index, a good 80, 90 points off the lows of this morning. We're doing fairly okay-ish from in the last 15 minutes or so. Just wanted to understand your thoughts on the Nifty Bank. That was underperforming a fair bit. Do you have any levels that one should be watching out for on the Nifty Bank?
So the Nifty banks actually held most of the recent lows. In fact, it's not even gone below the low that it made on the budget day. So if I actually look at the budget day low, which is around 39,400, then it got followed by a low of 39,600 in the end of February. So I think unless these lows really break, that's the bottoming range. If I look at the weekly bands there, and since we are closing for the week today, that's actually at 39878. So unless we really close below 39878, I think this is the bottom end of the range. So that's the risk versus the upside. Once we do base out here and start up, the upper band for the market could be Bank Nifty could be around 43,800.
Okay, got that. Rohit, the one space that you really do like is the metals, right? We've spoken about this many times on the show, and we have seen a bit of a recovery come through this month, at least not a bit. I mean, it's recovered a fair bit. Do you think this is something that's likely to continue also in the light of what's going on in China, the data suggesting that there's a recovery playing out there as well? Do you think the metals pack will stay firm?
I think so. We have seen a short-term correction, say, in copper prices. We are still seeing some weakness in aluminum prices. Steel prices are holding well. Yeah. I think the next 1 week is probably the volatility period, because everybody's watching the Fed and trying to figure out what will happen to the dollar, which is the main constituent that drives the metal index, because metal prices are driven by where the dollar is really headed. My sense is that there's good support in most of the metal prices. They are at their lows. And in fact, metal stocks themselves have retraced fairly well, around 50% of the gains that they made between June and December, which puts them in a pretty good place to resume the upward trend. Give it a week, I think, for it to stabilize around the news flows related to the interest rate position. Once that is done, I think you should get a fairly good rally in the metal space.
Well, thank you very much for joining in. Need to get into a break. We'll discuss commodities on the other side. Manisha Gupta joins in next.
Welcome back. You're still watching Trading Hour here on CNBC-TV18. We've seen a little bit of a slip, once more, 165 points lower on the Nifty. 17,425 is where we're at right now. The Nifty Bank is where you're seeing pretty much, the most pressure come through today. 650 points gone over there. So that is what is looking the weakest. But let's now talk about what's going on in the world of commodities, because there's been a big slip in the prices of crude oil as well. So Manisha joins us to tell us more about that. Manisha?
It hasn't been a strong start to the month of March when it comes to the crude oil prices. We're trading at a 2-week lows right now. And for this week itself, it's down by nearly 6%. Actually, it was in this week last year for March when we saw crude oil prices hitting that $130 per barrel mark. From those kind of levels to around 80, 81 right now is almost 38 to 40% of a decline that we've seen on an year-on-year basis come in for the crude oil prices. It has been about hawkish U.S. Fed, the U.S. dollar index trading on a firmer note, expectations of a more aggressive rate hike going forward from here. And add to that the fact that the Chinese imports of crude oil in the month of Feb were down 10% on an year-on-year basis. So while we have seen China recovery come in, but it is fragile and uneven at the best, and that continues to weigh onto the markets. What markets are watching out for is Total Energies, which is unable to make deliveries from its French refineries. Any development of that, if the supplies do not go through, then there could be some support for prices. But an even bigger data event clearly is the U.S. non-farm payroll data. Those numbers come in the evening today, and that would really set direction for the further crude price movement.
All right, Manisha, thanks a lot for that. Take a short break, but on the other side, we will discuss market technicals with Mitesh Thakkar and also his top trading bets. Stay tuned. Welcome back. The wee bit of a recovery has been sold into, so we're off mildly from the 200-day moving average once again, though a couple of stocks doing well on the Nifty. We have Shree Cement, which has recovered from the lows of trade. Titan too has recovered from the lows, still in the red, but at the higher end of today's trading range so far. HUL is doing extremely well. In fact, if the FMCG pack is actually what the street is looking at in terms of safety, given its staples as a nature is defensive as nature. So we'll watch out for these stocks. Are there any bets right now to be taken? Mitesh Thakkar joins in for a quick technical check. Mitesh, a big decline from highs yesterday, over 300 points, 170 points now. Would it make sense to take some shorts right now, or would anyone be, or should anyone be brave enough to perhaps take a contra long?
So, good morning, Manu. I think the overall sense is that 17,400 was the support area which I was looking at, and then 17,255. We actually got to as low as 17,325. But the structure, with the gap down, despite the fact that there is some recovery from the lows, is slightly on the weaker side. So the idea should be to explore more of short positions on bounce back. So I would want to possibly go short in the range of about 17,460 to about 17,500 zone, and then take a 50-point higher stop loss. 17,555 is what I recommend from there. And I think the retest of 17,255 looks very likely. So in that sense, a short-term view is slightly on the negative side.
Okay, and stocks?
Sorry.
Stocks, you said your short-term view on the index is negative. What about individual stocks? Would you go with a downward bias?
So I have one buy and one sell call right now. Granules is something which is breaking down. So that's a sell with a stop at 286. Look for targets of 270. And a cash stock, I think, that's come on the radar purely because of the fact that it's making a fresh breakout and a swing high. That's Dynamic Technologies. Keep a stop below 2790 here. Look for targets around 3100 in the next couple of weeks.
All right, got that. Mitesh, thanks a lot for bringing us that quick technical check on the market. We do need to get into a short break now, but when we come back, we're going to decode the outperformance of the power sector PSU stocks in 2023. That's the one space that has really been buzzing. So we'll bring you all of the details on the other side.
Welcome back. We've got a special clutter breaker for you. Today we put the spotlight on the power sector PSUs, which have outperformed in 2023 so far. Vivek is here to tell us what is fueling this outperformance. Vivek, over to you.
Well, the power sector PSU stocks have actually outperformed in 2023. With so much news flow regarding the rising demand and the government invoking an emergency clause, here is a deep dive in the power sector. Demand has been quite strong and growing in February, with peak demand constantly breaching 200 gigawatts on a daily basis. When you're talking about what exactly is causing this particular rise, it's a double whammy of heat waves, and the El Nino impact is expected to keep power demand quite high. The anticipated higher demand has prompted the Ministry of Power to invoke an emergency clause in the Electricity Act to support imported coal-based power plants to restart and to allow a cost pass-through. Generation trends too have remained quite strong in February 2023, with generation growth for February 2023 at 7% growth on a year-on-year basis. When you're talking about the PLF trends, they too have remained very strong in FY23. Now remember, PLFs were at 63.7% for the period of April 2022 to January 2023 versus 57.4% in the same period last year. When you're talking about pricing, that too has remained very strong and is expected to gain further ground going into the summer season. Merchant power prices gained 8% on a month-on-month basis in February 2023. Now, talking about the power sector stocks, why have they done so well in 2023? It's a combination of factors. Number one, utilities are seen as a defensive, high dividend yielding bet in a volatile environment. Now, when you add that with improving fundamentals like increasing PLF, lower discom dues, easing supply chain constraints, these two add to the positive sentiment. Brokerages remain quite bullish on all of these PSU power stocks. In fact, all of the brokerages have a positive stance on NTPC, with HSBC having a target price of 205 rupees a share. Citi too is very bullish on the prospects of Power Grid with a target price of 275 rupees a share.
Vivek, thanks a lot for getting us all of the details. So that is the power PSUs, which have been doing very well. In fact, on this same theme of higher power demand, we also caught up with Rajiv Kumar Vishnoi, who's Chairman and Managing Director at NHPC this morning, to understand what the demand trends are looking like, as well as, to get an update on some of their projects. So let's listen into that.
Demand has been consistently rising for last almost 17, 18 months, demand of power. And we see in some of the months it has been rising at the rate of 10% also. Now, at the same time, we have been adding capacities also. The country has been adding capacity, and this is the reason we could fulfill all of this demand last year also. There was a great surge in demand, and we could satisfactorily fulfill this demand. Subansiri is in the last stage of now getting completed. This project, and 2 units of this project will be commissioning rather, adding to the grid by the end of June this year. That will be towards the end of first quarter of FY24. Every 3 months, we'll be adding 2 more units every 3 months. So we'll be completing the full capacity in next 1 year or 14 months time. Regarding the Parvati, the first 2 units will be commissioned in the last quarter of FY24. There are a couple of big projects like Savalkot and Diwang, as rightly mentioned, which we'll be taking up very shortly. And we are looking at these projects to commission before the year 2031. The total capacity, other than these 2 projects, Bansari and Parvati 2, which is 2,800 megawatt. If you include this also, we'll be adding 7,000 megawatt, which is under construction at the moment, in another 3 years' time. We'll be starting construction this year only, in fact, from next month, next month. And the total construction period is 9 years.
All right, so that was some conversation coming in on the power sector. With that, we'll simply do a short break. But as we do that, a quick programming note. On the 14th of March, CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge gender inequality that exists in India and across the world. The event starts at 4:30 p.m. on the 14th of March. You can catch all the live action right here on CNBC-TV18.
Welcome back. You're still tuned into Trading Hour. It is still, we're not getting any kind of respite for the market right now. Still 170 points lower on the Nifty, and the Nifty Bank has actually extended its losses. It's down around 680 points as we speak. A few stocks, though, however, which are managing to do well. The FMCG pack, for sure, we have been mentioning that. So something like an HUL has seen a good move upwards. ITC is at the high point of the day. So these ones holding up, but also some from the auto pack. Tata Motors on news flow, of course, but you have Bajaj Auto, which has seen a sudden spike. So do keep that one on your radar. That is looking extremely, positive right now. It has moved up. And then you have a lot of the PSUs that we've been mentioning to you. So the likes of NTPC, Power Grid, which are once again the few stocks which are holding up in the green today. But with that, we are going to wind down on this edition of Trading Hour. As we do that, let me leave you with some important market opinion. This comes in from Dan Feynman of Credit Suisse. Thank you so much for watching.
We're cautious, and actually we've been concerned about the rally we had earlier in the year. We viewed it as a bear market rally. For us, rates are still an important issue, and we think the worst lies ahead of us for developed market economies. Emerging markets will do better than the U.S. The valuations are looking better. We don't have the inflation problem that you had in the U.S. There's no escape from the impact of higher rates in the markets where you've had big increases. I think in Asia, we don't need to worry about this as much. The rate increases haven't been as steep. Short term, I think that the dollar could be a bit firmer. This is because of the Fed becoming more activist again. But longer term, and I'm talking about, say, 3 years and beyond, longer term, the dollar looks problematic. Our belief that the dollar is going to be weak is a multi-year view. Short term, we're probably going to be seeing a bit of a bear market rally for the dollar. It should be positive for commodities, particularly. I would be particularly focusing on forward-facing commodities that would be benefiting from, say, the carbon transition. With EVs, a lot depends on policy support from the local national government. China stands out for how strong the policy support for EVs has been and probably will remain. India, less policy support, less excitement, I think. China does have an impact on funds flows elsewhere in Asia, and we have seen funds flows into India bounce back in March.
brought to you by HDFC Life. Sir,